In this video, I'll analyze the Q1 FY26 result and Concall of India Shelter Housing Finance. So let's start with the company overview. So India Shelter Housing Finance is an affordable housing finance company. 57% of their AUM comes from the segment of home loans, and then another 43% of their AUM comes from the loan against property segment. In terms of the geography, they are mainly present in the tier 2, tier 3 cities of Rajasthan, Maharashtra, Madhya Pradesh, and they are present in 15 different states across India. So in terms of geography, they are well diversified. In terms of the customer segment, they mainly prefer self-employed pupils, and in terms of the average ticket size, their ATS is around 10 lakh to 11 lakh rupees. So let's talk about the result of Q1 FY26. So in this quarter, they grew their AUM by 34%. Their AUM stands at a level of 8700 crore. And if we look at India Shelter's last few quarters, they have been growing at a rate of 34-36%, and in the Q1 FY26, India Shelter is the only affordable housing finance company to grow at a rate of 30%, over 30%. Okay, so that is one very important thing. In terms of the guidance also, they are giving a guidance of 30 to 35% AUM growth over next 2-3 years. And if I talk about their long term guidance, they are giving a guidance of 30,000 crore AUM by the end of FY30, which translates around 30% CAGR over next 5 years. So in terms of the guidance also, that is really good. 30% growth over next 5 years is really good. Okay, so that is one point. In terms of disbursement, they grew their disbursement by 24% in this quarter, which is a very good kind of a growth, because as we know that 22% of disbursement is sufficient to grow our AUM at a rate of 30%. So with a growth of 24%, they can easily grow at a 30 to 35%. So that is one point. So that is the point with the disbursement also. In terms of the branch addition, they added 24 new branches in this quarter, which is a very good kind of a rate. And if I talk about their yearly guidance, they are giving a guidance of 40 to 45 new branches every year. Okay, for next 3 years, which is a very good guidance. And I mean, in this quarter they already opened 20. In this year they already opened 24 branches. So rest of the year they have to open another 16 to 20 branch. So that is one very good point. And in the last year also they opened around 46 branches. Okay, so that is one very good point, because they are expanding at a very good rate. In terms of the asset quality, GNPA, NNPA have been very stable over last few quarters. So that is another really good point, that the asset quality with this kind of a growth, asset quality have been stable. So that is another really good point. So no problem in terms of the asset quality. But in terms of 30 plus DPD, in this quarter 30 plus DPD increased by 100 bps year on year, which is a little high. But again, if we look at their past also, obviously Q4 is the most strongest quarter in a financial year, whereas if we look at quarter 1, it is the weakest. Okay, so obviously out of this 100, 40-50 is the effect of seasonality, but another 50 bps is about the environment we are in. So that is one point. And if I talk about the management is saying that in the month of July also the 30 plus DPD is holding the level of Q1. So that is one good thing, and they are expecting that if they can able to hold the 30 plus DPD at a level of Q1, which is 4.5%, the H2 might be very better, and they are confident that if Q2 holds in the level of 4.5%, in the H2 they will recover, and they might end the year at a level of 3.2 to 3.3% 30 plus DPD. So that is another, okay kind of a thing, that the management is expecting a better kind of a 30 plus DPD going forward. In terms of the asset quality, I do not think there is much problem, because GNPA and NNPA have been very stable over last few quarters. And if we look at credit cost also, credit cost in this quarter increased by 10 bps and is at 0.5%. And if we look at their guidance, they have been guiding us for a 40 to 50 bps of credit cost for last several quarters, and they are holding the guidance. That is a very good thing, that because we know that Q1 is the toughest and the weakest quarter for any financials, and in this quarter if they are able to hold their guidance, we can expect a better quarters coming forward. So that is one thing. So in terms of the credit cost, they are holding their guidance at a level of 40 to 50 bps for next 1 year. So in terms of asset quality, I do not think there is any problem there. Obviously it is a lending company, it is a business, so it is very much obvious that sometimes the business moves in the upward direction, sometimes it is little stable, and I mean that it is completely fine that their asset quality is pretty much stable over last few quarters, so there is no point talking about it. In terms of the portfolio yield, in this quarter, the portfolio yield stable, and portfolio yield has been stable for last few quarters, and they are saying that because we know that the interest rate, RBI is cutting the interest rate for last few quarters, so they are saying that they will cut the interest after Q3. Okay, so that is the thing with the portfolio yield. So maybe a 20-25 bps of cut they will do after Q3, but till Q3 they are not going to cut any interest rate on their loans. Okay, in terms of the cost of borrowings, in this quarter, in the last 2 quarters, they have got a 20 bps cut in terms of the cost of borrowings, and they are expecting another 20 bps cut going forward in the year to FY26. So overall, if we see the spread has been in the range of 6 to 6.4 for last few quarters, and we can expect a similar kind of a spread going forward also, because as I said that they are expecting another 20 bps cut going forward in the year. And in terms of the portfolio yield also, they will cut 20-25 bps, so we can expect a similar kind of a spread of 6.4%, 6.3 to 6.5% going forward. So that is another very good point, that they and they are also guiding us for a 6% plus spread for next few years. So that is the thing, and they are at now 6.4%, which is very good. In terms of cost of income also, in this quarter the cost to income stands at a level of 35.1%, whereas if we look at FY25, the cost to income was at a level of 37.5%. So they are continuously getting the operating leverage. So that is another really good thing, that in terms of the spread, in terms of the NIM, they are doing good, but in terms of the operating portion also, they are doing really good. So that is one another good thing. Okay, so and they are guiding us for a 20 bps of reduction in terms of the OPEX to AUM, and OPEX to AUM is also in the similar kind of a range year on year. Okay, so that is good point. Year on year OPEX to AUM improved by 20 bps. So yeah, they are constantly getting the operating leverage. So that is one another good point, and they might also continue to get this kind of operating leverage going forward also. So that is the one, because they are expanding at a very good rate, and these branches will be matured in next few years. So going forward, obviously we can expect a operating leverage. So that is one point. In terms of the ROE, obviously if a company, if a NBFC is getting better spread, and if they are getting a better operating leverage, obviously ROE is going to expand. That is obvious thing. And in this quarter, they improved their ROE by 290 bps year on year, which is a very good kind of a increase in terms of the ROE. Okay, and quarter on quarter also they improved their ROE by 90 bps. So really good. They touched ROE of 17%. Now they are at a level of 17.2%, which is a very good thing, because they are guiding us for a 18% ROE for in next 2 years. So I mean, they already reached a level of 17%. So I think they can achieve 20% of ROE in next 2-3 years. So obviously they can do it. So let's see what happens in terms of the ROE, but they are really good. Okay, in terms of the ROE is going in the right direction at a very fast pace. So that is what matters. And going forward, they are guiding us for a 18% ROE by FY28. But I think by FY28 they should achieve a number of 20%. Okay, and in terms of the equity raise, they are saying that they might need a equity raise in the year of FY28, at the end of FY28. But again, I think if they can achieve 20% ROE, then this equity raise might get delayed another 1 year, because obviously if a company can reach a higher level of ROE, the lesser equity raise they will need. So that is one point. So that is why I am saying that if they can achieve a 20% ROE, their equity raise might get delayed. Okay, so that is one thing we have to keep in our mind. And they are saying we will raise the equity if we reach the 4.5x leverage mark, and they are now at a level of 2.9x leverage. So I think there is a good ample time to reach to that 4.5 mark. So that is one another thing. Overall, I would say it is a very good set of numbers, absolutely no doubt about that, and they have been doing really good in last few quarters. They have been really good. Okay, no doubt about that. In terms of the sector, in terms of the industry of affordable housing finance, they are the best, no doubt about that. They are the only company growing at a rate of 30%. So that is another good thing. So in terms of the industry, they are the best company in this industry, no doubt about that. if we look at the whole result, I would say there is only one negative thing is the 30 plus DPD. Otherwise, all the things are absolutely crystal clear. There is no problem in terms of anything in terms of growth, in terms of asset quality, all are very very clear. So nothing to say about it. They have been doing really good for last few quarters. So that's it for the video. Thanks for watching.